Let's begin. Good afternoon, everyone, and very warm welcome to you all. My name is Anuj Sonpal, CEO of Valorem Advisors. We represent the investor relations of Arisinfra Solutions Limited. So firstly, on behalf of the company, let me thank you all for participating in this event. And also, I would like to thank the management for participating with us today and for giving us this opportunity to host them for our Valorem CXO meet. The Valorem CXO Meet is the first of its kind virtual analyst meet event series, and our intention with these virtual CXO meets is to take advantage of technology platforms like this by reaching out to a wider audience and to create a better understanding and bring awareness about our client company's fundamental business, provide insights into their specific industry, financials, and future growth strategies. The format of this analyst meet will be primarily a Q&A interview format where I will start off by asking the management some broad level questions and then move on to questions from the participants. Please know that if you have any questions to ask the management, you can use the Q&A button at the bottom of your screen to post your questions, which I will ask on your behalf to the management. Now, before we begin, let me mention a short cautionary statement. Some of the statements made in today's meeting may be forward-looking in nature. Such forward-looking statements are subject to risks and uncertainties which could cause actual results to differ from those anticipated. Such statements are based on management's beliefs as well as assumptions made by and information currently available to management. Audiences are cautioned not to place any undue reliance on these forward-looking statements in making any investment decisions. Let me now introduce you to the management participating with us in today's meeting. We firstly have with us Mr. Ronak Morbia, Chairman and Managing Director and co-founder of the company. Ronak holds a bachelor's degree in commerce from Jai Hind College in the University of Bombay. He has been associated with the company since its incorporation and brings over 20 years of experience in scaling construction and infrastructure supply networks. He is responsible for shaping the company's technology vision, strategic direction, and overall business growth. We next have excuse me. We next have with us Mr. Bhavik Khara. He's the whole-time director and chief financial officer and also the co-founder of the company. Bhavik holds a bachelor's degree in science from Rutgers Business School in the State University of New York. Prior to joining the company, he was associated with EY in New York and for over 2.5 years. He has been associated with the company since 2021 and brings over 6 years of experience across tax accounting, construction, and the construction materials industry. He oversees the company's day-to-day operations, financial management, credit operations, and capital allocation strategy while driving financial discipline and scalable growth. We also have with us Mr. Srinivasan Gopalan, Chief Executive Officer of the company. He holds a bachelor's degree in commerce from R.A. Podar College of Commerce and Economics, University of Mumbai. He's a qualified chartered accountant and fellow member of the Institute of Cost Accountants of India. With over 20 years of experience across real estate, finance, business management, he leads the company's business development initiatives, customer relations, and credit strategy. Prior to Arisinfra, he was associated with the Vadva Group and ROW2 Technologies India Private Limited. Now, without any further delay, let's begin the session. So let me start with Ronak. My first question is for you, Ronak. So could you start by giving a brief overview of the company for some of the audience who may be looking at Aris for the first time today, and also take us through the company's journey since inception, highlighting maybe the milestones of the company that it has achieved over the years. Over to you, Ronak.
Yeah. Hi, everyone. Before I get into the company, I think it would be very important to understand the industry in general and the massive scale of it and what the problem really is, which most people would not relate to or would not understand. As we look around, in the city, across the country, the amount or the scale of infrastructure projects that are happening, right from the infrastructure activity to the roads, railway projects, metro projects, real estate, commercial, industrial. What most people don't realize is the amount of effort or what it takes to deliver even one truck of material. And when you look at this industry, which is billions of dollars, and about 50% of it is construction materials, you can only imagine that the problem at scale is enormous. And even with this kind of scale, there is not much price transparency, there is not much supply guarantees, there is no visibility when it comes to contractors or developers when they want to procure materials on a daily basis. It's a very mature process at play. There is a lot of business, a significant amount of it, which still runs on relationship and trust. This is the problem that we wanted to solve for. This is what we wanted to fix. And that is how, we started Aris in 2021. The problem does not remain of discovery. Everyone knows the kind of materials they want to buy, where they want to buy from. The problem is of supply chain. It's an extremely fragmented market. It's a regional market. It's not a very organized market. And the supply chain is not just complex, it is long at times. And the contractor usually has to go to a lot of layers to just get a few trucks of materials in time, also at the right price. So this is what we wanted to solve for. And you can basically look at us as this technology layer between vendors and customers who actually operate as a coordinated network instead of 1,000 smaller transactions. And that is how we streamline this entire supply chain of construction materials. Since inception, it's been about 5 years. FY26 is when we got listed. Uh, we closed our FY26 year at about 1,060 crores of revenue with a PAT of 60 crores. We grew almost 10 times in terms of PAT. We've delivered three very solid quarters, post the listing. And we believe that were at an inflection point where the business really matured and we pivoted towards the models that are working for us today. Thank you, Anuj.
Thank you, Bhavik. Sorry, Ronak. Next question, let me continue on this. So, you mentioned a bit about how the company operates at the intersection of the whole construction materials and technology, but could you help us understand the business model, the role of technology, and how Aris is solving these inefficiencies that exist within the India's highly fragmented construction procurement ecosystem?
Yes, sure. In this business, I think the easiest part is to actually find a buyer or find a supplier and to actually decide what to buy and what to sell. But what really is the complex process is everything in between, right from vendor coordination to management to negotiating the prices, closing the prices, arranging for documentation, getting the documents accepted, and then going into the arrangement of deliveries, recording of deliveries, and then finally generating the invoices. It is a very mature process. It does not work as buying a product online and paying for it. It's a credit environment that we operate in. The documentation is extremely important, and this is the process which is very, very crucial and the most underrated part of this business. When we were starting, because of my experience in this business, I knew that 80% of the time goes into managing and 20% goes into, generating the demand and actually closing down the orders. This is the part that we wanted to work on as a company. We developed technology right from scratch to solve this particular problem. And today, we have a platform which works through which the entire business process goes through, right from step one to step 10. And that's why most of our business process at the back end is automated, right from vendor management to pricing intelligence to credit management, and generation of invoices and recording of all deliveries, and integration of AI and ML also to reduce the time of recording deliveries from a few days to just a few seconds is where we have come today. Our back office team has not increased from the last 3 years when we have scaled almost 3 to 4x in terms of the revenue numbers on a monthly basis. Today, we handle about 900 deliveries a day. That's about, let's say, 2,000 to 3,000 documents on a daily basis with a lot of thousands of price combinations. We're able to fulfill this only because the technology is there and our entire business flows through this tech. So the real value add is not just one area where we see the benefit. It is multifold and it has a compounding effect on how we manage our business. And that's why we've been able to scale this business and more of our gross margin flows into the EBITDA and then eventually into PAT. So this is where we feel that tech is much more valuable to us in this industry where technology is nearly absent.
Great. Thanks, Ronak. So over the last few years, we've also seen Aris gradually evolving from B2B construction materials procurement primarily to now also doing contract manufacturing business. So can you walk us through what is the rationale behind this strategic shift? What are the advantages of the contract manufacturing model and how it helps improving profitability and then relationships, or what are we seeing in this vertical?
Yes. So we started with B2B construction materials platform. We started buying from vendors. We started creating a network of vendors supplying to customers, and that's how we were scaling. And in just the first year of business, we closed at a 450 crore of revenue. So we saw scale. We improved our network. We increased our network of vendors and customers. But what we realized is, as we move forward with larger orders coming in, it would be it would not be great to depend on external vendors for fulfilling such high value of orders. And we had two options. Either we invest in our own capex, put up our own plants, compete with the market, and build a whole team of production, or we look at the manufacturers who are existing in India today and almost all of them who are operating well under capacity and try to partner with them. This is the approach that we took. And today, 5 years down the line, we have partnered with 15 partner plants, which is a mix of stone aggregates and RMC. These are the products that we see really high value, and these are the most complex products to handle. And the cumulative total annual capacity that we control on this network today is more than 90 lakh metric tons, which is valued at just over 900 to 1,000 crores annually. And these are contracted for 5 years. So this is a model that we thought was much more capital efficient, would work with a lot less team and without the operational risks, but also capturing the entire economics of being a manufacturer. That's the real value add, and that is why we see that the EBITDA margins that we make in this particular category are significantly higher, and the dependency on customers on us is much more higher because there is no intermediary here. We directly supply to the hundreds of customers, infrastructure contractors and developers. So this is a very exciting segment, has grown from just 2% contribution in FY23 to about 47% in FY26. And we believe that we'll be able to cross about 55 to 60% contribution this year as well. It's the most exciting segment in materials that we have.
Okay, thank you, Ronak. Let me move on to the next question to Mr. Srinivasan. So the company has built a unique developer as a service model through its service business. Can you help us understand this model, the value proposition it offers to developers, investors, and landowners, and how it complements the company's core construction materials business?
Thank you, Anuj. It is a modest effort. What we are doing, developer as a service, is primarily a one-stop operating system for real estate projects, wherein we bring in money, material, and management, the three most required resources under one platform, and we implement them on behalf of investors, developers, or landowners. So, for example, our main aim is to monetize the asset. So that we have three sections under which we do. One, we call it Genesis, whereas there is a landowner and the landowner to monetization. Whatever that is required, what is to be planned on that land, get the architect, do the architecture on it, get the contractor, ensure that the project is implemented, do the sales, CRM, day-to-day cash flow management. This entire gamut until society formation is something that we take up that project and complete it on behalf of the landowner under his banner. So the biggest asset is he doesn't have any of those expertise, and we bring all those expertise on table. The second part is we call it project to money. Many times you start a project, you've got the approvals, you have started, and then somewhere you're lost. You suddenly realize that there are too many variables which you are not able to manage. That's where we step in. Again, we do the entire gamut until society formation. And the third one is we call it catalyst, which is units or completed products to monetization. So you have built something of value, but again, you're not able to monetize that. And that is where we step in and bring in the expertise, everything under one roof to monetize that. So ultimately, conversion of an asset, whether it is a non-performing asset or a performing asset, to money is what DAS does. So typically, to give you an example, who are the people who come to us, right? So the early people who came to us are these kind of Blackstones, and Blackstone got two or three projects in Virasat from Merrill Lynch during the 2007-2008 crisis. The buildings were half done. The sales were not done. And that was not the core business for Blackstone. So they appointed us to monetize that entire thing, and we completed those. The second example is where InvestCorp, they had two projects, and they had invested in projects, and the projects had gone belly up. The developer had gone belly up. It was at a land stage. From there, developing five towers, 200 apartments, delivering those. That is what we did. Some of the other types of projects are those landowners who want to build their own brand and become developers. That's where we step in. So this is what developer as a service does. And if you look at the synergy between what Aris does, is primarily every developer to whom we sell material is a potential DAS project for us. And with DAS, every project that we do, the entire material is supplied by our the platform, which is the material platform. So there is a lot of synergy. Just to give you an example, I was just telling someone 3 years back, the turnover coming from DAS was around 6 crores. And last year, that is 25, 26, we landed up with a 98 crore top line for it. And also very high margin, because all you need is a fixed cost of a few people, good talented people that we have been able to attract. We are able to generate between 50 to 60% EBITDA margin on this business. So that's what DAS does. It's a one-stop shop. And we also have a tech background to this. We are able to monitor the project real time and give it a score. We call it as a project health score, project health index, wherein there are approximately 90 to 95 parameters which are actually compared and marked based on certain weighted average and algorithms that we have put behind it to say whether the project is on time, whether the project is doing well on cash flow side, on sales side, how is the legal problem of the project impacting your sales, impacting your collections, so on and so forth. So it's a very integrated thing, very unique, and I think nobody else other than Aris which actually does this as of today.
No, thank you for that, Srini. I think that's very interesting. Just to clarify a few aspects on the DAS model, first of all, it's a service model. So there is no, is there any risk of capital or involvement
Nothing.
of capital? So it's a pure service model.
It's a
And the risk lies on the customers we have. All we are doing is providing our expertise and service to execute
absolute.
this. And obviously, whatever models we are using, whether it's bringing in financing, etc., there is no commitment from Aris's side. It's just it's the expertise that you're bringing, right?
Absolutely. It's a service. We are completely asset light. There is no requirement of working capital as well. So whatever that comes out of this is flows directly from sales to EBITDA.
Correct. And it's customizable as to whatever the problem of the customer is.
Exactly. But if you see 80% of the problems are similar, it's only the
Sure.
20% that requires some amount of tweaking.
Sure, sure. No, very interesting. Um, Moving on, let me ask my final question to Bhavik, and then we'll take the questions from the participants. Bhavik, obviously the company has had delivered a significant improvement in both top line, bottom line over the last few years, and especially last year was a very great turnaround. Could you help us understand the key drivers behind this improvement? Also, could you help us understand how Aris approaches the whole working capital optimization, credit risk management, cash flow discipline, while continuing to scale its operations across all these verticals. We also, to just add on that, I know Ronak touched upon, the economies of scale that brings in. So, is it that's what playing out, and can you explain the financial performance?
Sure, sure. So thanks, Anuj, for the question. Let me quickly give you a rundown on the numbers before I get into the specifics. Like Ronak mentioned, the revenue that we closed for this financial year was 1,067 crores, with an EBITDA of about 107 crores, which is almost twice as much compared to last year. We also did a PAT of 60 crores compared to PAT of 6 crores last year. So we've obviously shown significant increase across all functions. Some of the key drivers in terms of margin expansion, right, is the growth in contract manufacturing. Contract manufacturing provides us EBITDA margins north of 9.5%, right? We've increased that to about 47% of our total revenue. That has really helps us in increasing our overall gross margins and EBITDA as well. Second is the DaaS model, which Srini sort of put light upon, right? DaaS, like Srini said, we've grown almost 15x in the last 4-5 years. It accounted almost 9% of the total revenue in FY26. And these are good, healthy 50-55% EBITDA margin businesses. So combination of increase in contract manufacturing services. On top of that, the product portfolio that we've picked, we've historically been very heavy in steel and cement, right? In the last 2 years, we've moved away from the strategy and tried to go towards product portfolios which are more complex, more operationally challenging to deliver. And by that nature, are sort of high margin, high gross margin, high beta margin businesses, right? So our steel and cement contributed only 13% of the total revenue compared to 45-50% 2-3 years ago, right? We've moved more and more towards complex materials like aggregates, ready-mix concrete, asphalt and bitumen, which are high margin, low working capital businesses. And in the future, we endeavor to sort of keep on growing that as well. And like you mentioned, the whole economies of scale and the technology has really helped us in the operating nature as well. The operating leverage is yet to 100% kick in, but we're already seeing the results of the technology, where the revenue growth is not being aligned with the expense growth or the human capital cost growth that we are envisaging, right? So there's a few reasons and few sort of explanations on driving the margin expansion. If you look at our working capital as well, we've improved significantly. 110 days of net working capital cycle last year to 66 days, right? This has obviously, because we've been very diligent in terms of our revenue, in terms of our customer selection, we have mechanisms in place in using our technology on how to analyze each and every customer, how to give credit scores to each and every customer. We obviously use market research, market information, but we also make sure the fact that we have the contract manufacturing and like Ronak mentioned, that the dependency of customer is much higher on us. And with the DaaS as well, when we have entire cash flows of the project, we are getting paid on time. We are able to, obviously, because of economies of scale, we are able to extract better payable days from vendors as well. And that's the strategy going forward, right? We want to make sure that the working capital is crisp, working capital is not going out of hand, because that is one of the growth drivers for us as well. In terms of balance sheet, last year we were at about 1.25% debt, 1.25 debt to equity ratio, right? Which we are in this last financial year about negative 0.09. This again is because we've been net cash flow positive from operations, right? We've turned that around as well for ourselves. And that's because of higher profitability, better working capital cycles, and making sure that the growth, it doesn't come at expense of profitability. So we want to be very sure how we are growing sustainably. We want to make sure that in terms of chasing growth, we do not take a hit on the profitability. We want to keep our balance sheet strong. We want to make sure that the receivables and payables are in check and at a good profitable business at the core of it, right? So that is an overall strategy we want to we want to go forward with, and that's what we've achieved and showed in the last financial year as well.
No,
Thanks.
that's fantastic, Bhavik. Thank you so much. So yeah, I think that covered almost in brief the whole business aspects. At this point, let's start taking questions from the participants. Once again, everyone, if you have a question, please use the Q&A button at the bottom of your screen to ask them. And I will ask these questions to the management on your behalf, as many as possible. So let me start taking a few questions. The first question comes from Rohan. Can you explain the unit economics of the contract manufacturing in simple terms? Why will companies with spare capacity not just sell directly?
Yes. So let's take an example of aggregates manufacturing facility. It does not work like a simple factory where you can store the products, keep it as inventory, and then sell it as per your convenience. This almost has to be tuned to live demand. So your demand, your supply, and your customer relationship and receivables and the fund flow that you have at your disposal for production, everything has to go hand in hand. And if you look at most of the manufacturers today, they are operating well under capacity for this very reason, because the industry is significantly unpredictable. Customers don't have regular recurring demand. Customers are not very good at regular on-time payments. And the capital required to pay your fixed costs and to keep the production going is required almost on a daily basis. That's where the unit economics go for a toss. Now compare the situation where they're operating at, let's say, 25 to 30% of capacity. And when a platform like Aris comes in with a lot more demand, a lot more wider reach, and a lot more customer relationships to navigate through the fluctuations of all of the reasons that I spoke about, the utilization naturally goes up. The working capital management is a lot better. A lot more smaller or bilateral relationships are managed, streamlined, and coordinated well. And the utilization, when it goes up, the unit economics significantly improve. And that is where we actually command our volume discounts. So this is how the structure works when you compare even a RMC manufacturing plant to even a blocks manufacturing plant. The real challenge is to tune everything to live demand, and the manufacturer is never in a position to start new relationships only because an existing one is dealing payments, because that itself means it's a new investment. So they are restricted by a lot of other things than just capital. This is what we bring onto the table, not just on the supply side but on the demand side as well. So there's significant value added to the manufacturer with a platform like Aris in between.
Thank you, Ronak. Next question comes from Sarang. How did they win trust of players like Blackstone for their DaaS segment?
So let me put it in this manner. One is I've been in this industry for more than 20 years, and initially it is just those relationships that really help. So that was one. The second thing is the both the projects for them was a monkey on their back. They wanted someone else to actually implement those. So it worked both. It worked on both sides. When they saw us implementing the first one, that gave them confidence to give us the second project, and that's how the entire thing started.
You're on mute, Anuj.
Sorry about that. Next question from Shaurya is, what is the FY26 revenue breakup across our segments?
Yeah, so FY26, we ended up with 47% revenue contribution from contract manufacturing, about 43% from the B2B trade segment, and the rest 9 to 10% from DaaS vertical. This is how this is what we achieved in FY26.
Okay. Next question from Aditya is, any revenue guidance and EBITDA margin guidance for the next 2 years? How will revenue scale up? Yeah,
Yes.
go ahead.
So as mentioned earlier also in one of our interviews, we will again go for a revenue growth of approximately 35 to 40%. That is what we achieved last year as well. And if you look at the EBITDA improvement and the PAT profitability, we expect the profitability to sustain those levels, if not improve. And we're very confident because of a few reasons, because we expect the contribution from contract manufacturing to improve. We expect the services vertical to sustain at maybe a 8 to 10% contribution. And also because of introduction of a very new exciting vertical in terms of asphalt. That's one of the product categories that we're very excited about. When you look at any road projects today, we were present across all the different layers of aggregates that are required. But this adds to that last finishing layer also, which is a very niche segment, but a very, very exciting one in terms of the kind of margins and the kind of working capital that is required. And we expect to deliver good numbers in this vertical as well. So, this is how we actually foresee without disclosing absolute numbers. But yes, historical guidance would be good proof for how we will perform this year as well.
Okay, thanks, Ronak. Next question from Tushar Sada is, please explain details of your receivables. Which business do they relate to? What are the credit terms? Margins in B2B are 2%. Is this business with zero receivables?
Yes. So first, let me clear that the segmental EBITDA margins are just estimates, and these are management estimates. Only because we allocate all of the corporate or overhead costs to the B2B trade segment. Because in contract manufacturing, all of the costs related to production are outside of the business, and whatever we get is predominantly the final EBITDA margins that we record in our books. So this is just to give an idea of how the contract manufacturing segment delivers.
Sorry, I think he's talking about previous numbers, so FY26 numbers.
Yeah, FY26 numbers. Yes, yes. And with respect to receivables, in terms of B2B trade, the receivables are slightly on the higher side, but also the payables, because we get supplier favorable credit from suppliers. And these include a lot more other materials than just aggregates and concrete, where it is electricals, plumbing, tiles, all of these other products. With respect to contract manufacturing, it's very exciting because the receivables is under 90 days, but payables is faster because we technically act as manufacturers, and the dependency on the customer is very of the customer on us is very high, and that's why the payment discipline is maintained. With respect to DAS, the receivables is there, but there is no infusion of capital. So a combination is what we look at instead of individual segments, because that is the kind of strategy that we have in the market. B2B is like an entry point or developing a customer relationship. We go deeper when the projects are larger with contract manufacturing, and DAS is well integrated into both the models. So I think the overall numbers actually give a better story of how we are operating today.
Sure. A follow-up question from Tushar Sardaji is, next question, why have you pivoted from solving issue of material availability to doing real estate projects? Should one view Aris as real estate developer, albeit for a fee?
I think it's how you look at it. It's just a matter of perspective. When we started, we wanted to create a network of construction materials. What we believed is we wanted to be that operating layer in the construction industry and not just be a vendor to customers. Now that opened up a lot of other areas, because we realized that real estate developers or contractors just don't have problems in terms of materials, but they also have problems in terms of execution. And once we entered that layer as well, we realized that the dependency of them on us, or the ability of us acting as a partner and not just a vendor to materials, was significantly higher. And we would be a lot more integrated into their system and present across the value chain. We saw a lot of value add in terms of how we handle the business. There's not much of a difference. And that's the real advantage of it. We don't do anything different to actually operate in multiple segments. It almost goes hand in hand. We have specialized teams, we have technology, and we have the experience to handle this kind of business. So we see this as an integrated model, the operating layer of construction that India has not seen till today.
I think the most important differentiation vis-a-vis a real estate developer is that you don't have any risk. While most real estate developers who are coming to you have a lot of risk, and hence they're coming to you.
Yeah.
So it's just a service model, not an asset heavy or capital intensive model, right? Next question from Sarang is, what are the risks faced by Aris in the B2B segment and in the contract manufacturing segment?
Well, we have mentioned this repeatedly on calls. The business risks in our line of business are minimal because of the presence of a larger network. The fulfillment is close to 100%. We are able to fulfill this because of a larger network of vendors and specific partners we have for all these materials. The biggest risk that we carry is the one we talk about the most, is receivable risk and working capital. As long as we are able to manage that, navigate through delayed payments, which are a given in this industry. So we never bet on changing the industry, or we never said that we will get paid faster. We just wanted to create a system or create a business model that would navigate through these delayed payments and still come out of it with good return on capital employed and with much less impact on our receivables. So the focus always is on cash flows. The focus always is on managing receivables. That's the biggest risk that we carry.
Sure. Next question from Rohan John is, what is the working capital requirement required for contract manufacturing side of the business? I don't know if we already covered this. I think we did.
Yeah.
Moving on, what are usually the payment terms with customers?
On an average, we offer about 60 to 90 days of credit. That's the average credit that everyone offers in the market. We are present in the same chain as the contractors, who themselves have a credit cycle of 90 to 120 days. So everyone is paid in that value chain accordingly. We operate in a credit environment. Payment delays do happen, and there are times when the projects get slower, get faster. All of this is a part of the business. So this is we offer about 60 to 90 days on an average, and today that number has come down to about 108 days with respect to just receivables.
Next question from Anupam Jain is that do we expect cash flow from operations to be positive, or what are the cash flow from operation expectations?
Well, yes. So in FY26, we were positive. We showed good numbers. We delivered good numbers with respect to that. And we believe that the model is designed to stay like that. It was not a one-off good quarter or maybe two good quarters that got us there. That's how the model is designed. And as long as we are able to kind of deliver this, the numbers that we project, we are very positive that we will be cash flow from operations positive in this financial year as well.
And the more the contract manufacturing business grows,
Yes.
the more it will throw out
Correct.
free cash flows.
Correct.
Next question from Bhavin Rupani is, how do we look at CAC, AOV, customer stickiness? Can you please elaborate on all the above?
So we're purely B2B. It does not operate as a typical B2C segment. If you look at the top 10 customers, it is concentrated, but that actually is loyalty in our business. That is stickiness that we look for. That is dependency that we look for, because the switching costs for these customers is very, very high. For example, the topmost customer, we are involved in more than 15 projects. We handle more than 500 vendors for them, more than 100 SKUs. So it's not just one customer, but every customer, there are multiple projects in multiple regions. So it's very diversified. Customer acquisition cost is none, actually. We don't operate like that. We don't spend anything in marketing. Retention is directly related to the service fulfillment and reliability, which we have proven time and again, even with the topmost infra companies who are with us today. So we don't see us as that. We spend very little on marketing and all of that. And we, usually we've seen that the customers never leave us. If they're not with us, it's most probably because we chose to leave them.
And I think we have also, it's important to also say about the recent acquisitions of customers and their large orders that they have committed to us. You want to talk about that a bit?
Yes. That's a very interesting point. We secured our contracts on the supply side with the 90 million metric tons capacity that I spoke about, but we wanted to try something different on the demand side as well. Lock in predictable revenue for the next 3 to 5 years. And the first one we announced was with capacity, with about 500-600 crores of historical revenue and yearly procurement. I think in FY26 we crossed about 180 to 200 crores. We've signed a contract to do about 800 crores of business together, and that gives us a solid, predictable revenue model on the demand side as well, which is predominantly the B2B trade segment. And we expect a few more to sign, this financial year as well. So we are trying to convert this entire model as predictable as possible, so we can plan out in advance, and which actually helps us manage our working capital a lot more efficiently.
Sure. Next question from Vivek is, how do you see the TAM of the DaaS segment? I mean, a market is not immune to this type of model, and convincing players could be challenging. How do you see this evolve in next couple of years?
So I mentioned in your earlier question that we moved on from a 6 crore 3 years back to a 100 crore top line. And we are currently managing a GDV of around 1,500 crores. And you look at the size of, and this is primarily in Bangalore right now. So we are yet to explore Chennai, we are yet to explore Mumbai. We have only 2 projects in Mumbai that we are currently doing. So we may not have official figures of TAM for DaaS as such, but just Chennai, Bangalore, Mumbai, and Hyderabad constitute around 60% of the total real estate turnover of India. So that's the kind of size that we are talking about. And apart from the top 20 listed entities which are into this real estate, everybody else is an addressable market for us.
Okay. Next question is from Shailesh Kumar. It's on the same front. Is there any I think you've answered this, but is there any definitive way to predict DaaS revenues in advance for next financial year? I mean, you mentioned that you have a GDV of 1,500 crores. So potentially that's your, potential revenue if you sell it. But is that right?
Yeah, that's true. So that gives us a real predictability on our DaaS revenues as well. So we know that in the next 18 to 24 months, what's the GDV? And then there is obviously you sell and execute. And however efficient that you are, you just keep adding to your revenue.
And there'll be other services also that you provide which are not a part of this GDV. Sales is just one, right?
No, so GDV is not only sales, right? We do the entire development. And
Okay.
the measure is the same because the fee is based on a 12 to 14% on the top line.
Got it.
Yeah.
Next question, again, follow up from Tushar G is payable is 173 crores, but receivable is 410 crores. So what is the receivable days in each division?
Receivable days in each division. If I had to give you ballpark numbers, I think in B2B trade, the receivables would be somewhere around 130 to 140 days. In terms of contract manufacturing, it would be somewhere around 85 to 90 days. And services usually has a receivable period of about
140 to 150
yeah,
days.
about 4 to 5 months, I would say.
Yeah.
So on an average, we come at around 108 to 109 days.
Okay. Next question from Sarak Sanil is, would scaling up of contract manufacturing segment hold up cash because of the advances that we give to the asset owners? Do we have a plan to cap figure?
In fact, it's actually the other way around. Whatever investments that needed to be done are already done, and this actually gives us predictable revenue or the inventory, not just for 1 year, for the next 5 years. So the advances and deposits that we have actually extended give us about 4,000 to 5,000 crores of inventory for the next 5 years. So that requires no more advances or deposits. Deposits will only be required to improve or increase our capacity as we move forward. And that is something that we look to do at any given point in time, because opportunities which are exciting give you not just 1 year of revenue, but multi-year revenue. And that is what, that is how we like to actually run the business as well.
Okay. Next question is from Vivek is, which segment will be seen as major contributor in overall revenue in the next 2 to 3 years?
I think that would have to be contract manufacturing.
Okay. Next question from Sahil Chopra is, what kind of audit fee hike PwC was asking, tentative range? Is it worthwhile to move to a below Big Four? What were the other issues auditors were facing?
I think other than the fee issue, we don't have anything else. We are very comfortable, but we don't want to reveal the fees that they are.
I agree.
Yeah.
Next question from Anand Sabu is, who takes responsibility for the delivery of construction materials and who initially makes the payment for these materials?
So we do all of it. I mean, we are a one-stop shop for everything. We do everything from vendor management to delivery. So right from sourcing, quality, delivery, documentation, payments, everything is handled by us. And for the customer, we are that one point of contact. We assume all responsibility.
Sure. Next question from Dia Jain is, order book as of what is the order book as of date and execution timeline?
Yes. So we don't operate on traditional order books. I think it's a combination of the inventory that we have for the next 5 years, which is about 4,000 to 5,000 crores. The B2B contracts that we have in place, the first one that we signed, which is about 800 crores, that's not overlapping, that is independent of that. And then the DAS revenue that we have, we locked in before the start of this year, which is about 120 to 130 crores, with a cross-selling opportunity of another 300, 400 crores. And that's the next 2 years. So cumulatively, I think we could easily say that about 6,000 crores in the next 5 years, even without starting work this year as well.
Next question from Sahil Chopra is, whether recent long-term contracts with real estate developers are MOU in nature. What kind? Okay, there's multiple questions. You can answer one by one. Are they MOU in nature?
So no, all of them are actual contracts, right? So it's not something that you can just enter into a DAS and get out of it soon. So all of them are long-term in nature, and these are proper contracts that we have entered into, including the recent one which we entered with the Vadwa Group.
Okay. His next question follow-up is, what kind of margins those orders have?
So I think I mentioned to you the EBITDA that we generally make is between 55 to 60% of the top line of the fees that we make under DAS.
Follow-up is, can we assume B2B contract margins? Can we assume B2B contract margins for those contracts?
Yeah, so it's like any other contract. It depends on the material that is required for these DAS projects. If it is through our contract manufacturing, then we keep those margins. And if it's a B2B, then we. So there is no differentiation between the two.
A point to
Okay.
note is the margins are not a function of any customer. The margins are a function of our procurement strength and the kind of partnerships that we have. So the customer never pays us more. It comes from our procurement.
Okay. Who will bear cost escalations?
Usually it is a part of the purchase order that we have. That is why we don't have very long contracts in place, because it usually involves a lot of disputes and arguments, because there are many variables when it comes to supplying materials and the prices. So these are limited to quantities. When there is a price escalation, we go back to the customer requesting for a price escalation. If that is not entertained, we go back to the vendor. So it is a negotiation on both sides. We usually map it well so that we maintain our margins.
There's no risk on that to
Absolutely.
There
us.
is absolutely no pricing risk, no stock risk.
Nothing. Once the deal is locked, the prices are locked. And the new deal, if we are not making good margins, there is always an option to not take up the deal as well.
Its follow-up is any specific reason behind fall in stock despite good reported numbers? Is there any large investors exiting as this? This is market-related aspects. I mean, as your IR, I mean, every stock has fallen down, so I would like to excuse these kind of questions. Whether promoters are planning to buy shares from the market post good turnaround and strong outlook. I mean, you'll have just done IPO. Is there any thoughts on that?
Well, we were in discussions. There's not a concrete decision as of now, but that could be a genuine option.
And also, Anuj, to be very honest, we hadn't done any OFS, right? Everything was direct. And what we concentrate on is on the business right now. I mean, we believe that the stock market or something, it's not in our hands, and I leave it in your able hands to take care of us.
I think that's well, about my able hands or not, but I think it's a good idea. Please focus on the business. I'm sure we'll find the value.
Right.
Ultimately, we have just done an IPO, so there's no point in buying. Please use that money
Absolutely.
wisely for the company.
Yeah.
Next question is by Anand Sabu. Risk arising out of payments you make, of these payments you make. I think we've already answered that. Next question is, since DAS seems to have more human intervention in terms of negotiation and execution, would it mean that only large ticket size projects will be taken?
No, not really. I mean, our sweet spot is between, say, 60 crores of GDV to 100 crore of GDV. So the size of the project does not really matter. It ultimately the challenge that we are able to resolve and the money that we are making. I think it's very clear that these are the two prime concerns for us before taking up a project.
Next question is, how much is technology really used in this? It sounds very laborious and manual in all, I assume, in all our business verticals. So if you could talk about technology and what are we doing?
Exactly. Yeah. I mean, if you look at this business, if you really know about how things work, if you look at any construction activity, if you would have seen a transit mixer in your life or an aggregates truck, the amount of procedure that is required to actually load the truck and weigh the truck and then get it delivered and get the document signed, get it back to the system. There is a whole team working on it. And when it comes to a platform like us, when we are delivering from to hundreds of delivery sites across India, procuring from hundreds of sites across India, and the prices are all variable nature. It's thousands of price combinations, and when you have to do everything in real time and to generate invoices in real time, only to stick to the credit period that you're offering to the customer, and then eventually collecting payments and being on top of receivables real time and taking all of these decisions real time again, and that to informed decisions. This is where everything is interrelated, dependent on each other, and this entire process is very, very complicated when it comes to handling everything manually. This is where the technology helps us. Every activity that is handled by the system automatically saves us a lot of time, saves us a lot of workforce. In fact, our scale will be a lot less dependent on the workforce and will be more and more dependent on the system to actually do the entire process. This is where we feel that the scaling up will be much more efficient, but a lot more accurate, a lot more real time, and a lot more time saving and cost saving for us. This is the power of tech. It's not glossy, it's not an app, it's not customer facing, but it really helps in managing this entire business. And that is why we are able to fulfill and get the numbers that we are delivering. It's only because of the backbone that we have, which is the technology.
Hey, the follow-up question out here is, do you use AI or plan to use AI for any of these activities?
To be honest, we are already using AI. We've already put a lot of use of AI into every part of the process that we have automated. For example, today, every delivery that we do and the delivery document, which is particularly hard to read, even if I give it to any one of you guys, is recorded on the system with a simple picture upload. And we do that with 98% plus accuracy. Every customer data or a credit profile is available real time, just as a conversation for anyone in the team. Real time analysis of multiple customers is also available. Top customers, top vendors, payments done. Every manufacturing facility that we are operating with, we have about 15 partner plants. About 10 of those are automated today. Every truck that is loaded on the weighbridge is entered into the system, and a lot of AI goes into analyzing those data points and getting us the data which are important to run the business. So yes, it's something that we started early. We use it very differently, not how people understand AI in general sense, but it is our use of AI and our use of the data that we have to run the business. And we expect this integration to only compound as we move forward.
Next question is, has the company seen any slowdown in infrastructure or real estate ordering activity post-March?
Not really. I think, people really talk about seasonality or cyclical business. But if you look at companies, there is a company which would be doing 10 crores of revenue on an annual basis. We do about 1,000. There are companies which are doing maybe 10,000. Everyone maintains their run rate. It's more of a strategic choice, if you ask me. We know which quarters we want to push on. We know when the cash flows are going to be strong. We use that experience to kind of control the pace and not just go with the demand that already exists. So yeah, we are not seeing any slowdown in terms of real estate activity and infrastructure activity. Thousands of crores of activity happening. We are at just 1,000 crore revenue annually. So not much of an impact. It's more of a strategic choice, even if we decide.
Follow-up question out here is, with the ongoing West Asia geopolitical tensions leading to increase in construction material prices, how does the management assess the impact on Addis's business?
So not much of an impact. The only impact that we've seen is on bitumen because it's imported, and it's, I think, a change in behavior where the working capital investment is required a little early to book the material so as to fulfill those orders. So that I could say is a pro and a con. Because the working capital is required early, there is infusion of capital, but that gives you dividends because the margins are sustained and you're able to fulfill those orders. So I think it's a behavioral shift, not much of a significant impact or a negative impact on the business.
The next question from Vivek is, to fuel aggressive growth of 40-45%, do we see this funded through internal accruals or any fundraise is in the pipeline?
So predominantly, our strategy for the next couple of years is going to be using the working capital limits from the banks, and that is actually to bridge between the payables and receivables, and that is most of the timing gap. It is not really about getting new funding or investing, but it is about we fund the materials first, we collect the payments later. It is about bridging this timing gap. If you look at our receivables last year, we grew about 25 to 26% in terms of total receivables, but our revenue grew by about 40%. And our payables improved by about 120%. So we expect this gap to be, I would say, almost negligible, so that at the end of the year, when you look at the net cash required to sustain this growth, was minimal. And that's how we would like to see it. And that is how we would like to, that's how the model is designed as well, to bridge the gap between payables and receivables.
On the next question is on the contract manufacturing business. What is the roadmap for scaling reserved capacity beyond the current 9 million metric tons?
So we're constantly looking out for more and more capacities through existing vendors, through new vendors, maybe new regions or maybe new products. That's how we came across asphalt, and that gave us a new vertical as well. So we are constantly searching for more and more capacities. it is not necessary to sign 100% all the time. We are increasing our capacity with more and more vendors that are onboarded on a monthly basis. So it's I think an ongoing business process instead of a major acquisition event in our line of business.
So any targets of how much or how many new contract manufacturing plants you want on board or anything like that, or capacity?
I think we would maybe target another maybe 1.5 to 2 million this year if the opportunity is very exciting. The next focus is always going to be in utilizing the 9 million that we have, because we are at a utilization of 65 to 70%.
Sure. Next question is on the DaaS vertical. What is the average project size and tenure in the DaaS vertical?
So the average tenure is between 18 to 24 months. We do a lot of land development, plotted development, and villas. So the entry and exit is pretty quick. And as I said, the sweet spot is between 60 to 100 crores. So that would be the GDV for a project.
The follow-up out here is, what proportion of DaaS projects are stressed asset turnarounds versus greenfield developments?
So let's put it into three buckets. So 20% would be stressed, and 40 equal amount would be from institutions and from landowners or developers.
Or greenfield?
Yeah.
Okay. Next question from Sarang is, what is the peak revenue potential from this existing 9 million ton capacity?
So close to 900 crores per annum every year.
Okay. That was the last question on the chat. So, and right in time, we've been able to exhaust everyone's questions. This is very good questions and great answers also. Thank you, management, for this really good interactive session. And thank you, participants, for a lot of great questions. If you have any further questions, please reach out to us and we'd be happy to help you with it or even arrange a meeting with the management. Again, thank you, management. Any closing remarks?
We would just like to thank everyone for joining this call and appreciate the questions. Like Anuj said, we would love to meet all of you all if you want to discuss anything further. Thank you for your time.
Great. Thank you, everyone.
Thank you.
Thank you. Bye.